Welcome to this explainer. Look, if you've been watching the markets lately, you know we are living through a totally bizarre reality right now. On one hand, we're seeing this unprecedented wealth generation and these massive technological leaps. But on the other hand, we're dealing with profound geopolitical instability and some really painful economic pinch points. So today, we're going to unpack exactly what is happening in May 2026, and we'll use the data to make sense of this incredible market paradox.
Let's kick things off with an absolute jaw-dropper of a number. 38.4%. Okay, that is the massive, almost unbelievable jump the PHLX Semiconductor Index saw in the month of April alone. Just to put that into perspective, that's its best month since the dot-com boom all the way back in February 2000. It's a historic surge, and it's being driven entirely by this absolute frenzy for computer chips.
And honestly, this brilliantly sets up the paradox we are examining today. It's like a giant split screen. In one corner, major stock indexes are just hitting record highs, completely propelled by this tech euphoria. But then, over in the other corner, we have the incredibly sobering reality of an ongoing conflict in the Middle East. Specifically, an intense blockade in the Strait of Hormuz that is just choking global supply lines. So how in the world can both of these things be true at the exact same time?
That brings us to Section 1, Stocks Defy the Odds.
Let's see how these crazy contrasting forces are actually playing out on the trading floor, because against all conventional logic, the markets are partying like it's a post-pandemic rebound. They are completely defying historical odds. Despite all the obvious global tensions, the Nasdaq composite just clinched its best month since April 2020. And meanwhile, the S&P 500 and the Russell 2000 both closed at all-time records. Historically, the S&P 500 rarely jumps more than 10% in a single month. I mean, it's only happened a handful of times since the 1990s, yet here we are. The market is showing this bulletproof resilience that literally has analysts scratching their heads.
Moving right along to Section 2, Big Tech's AI Spree.
To understand this resilience, we have to talk about the absolute hero of this market story, which is undoubtedly artificial intelligence. Check out this figure, $131 billion. That is what just 4 companies, Microsoft, Meta, Amazon, and Alphabet, collectively spent on AI data centers in the first quarter of this year alone. They are pouring money into the physical foundation of AI at a scale that's genuinely hard to wrap your head around. And it's this tsunami of capital that is keeping the broader markets afloat right now.
But here's the thing, it's not a rising tide lifting all boats equally. Notice the mixed bag of earnings we got from this massive spending. Alphabet surged 10%, largely because their Google Cloud revenue jumped a massive 63%, proving that their AI bets are already paying off. Apple beat expectations too, with solid iPhone sales. But then, look at Microsoft and Meta. Even though they're AI pioneers, investors actually punished their stocks, dropping them 3.9% and 8.6% respectively. Why? Well, purely out of fear that this massive $131 billion AI spend is going to just crush their short-term profit margins before it ever generates a return.
So, to put those margin fears into perspective, analysts at Evercore ISI confirm this spending spree isn't ending anytime soon. Actually, they describe the spending on AI infrastructure as re-accelerating, not flattening. So while the tech investors might be sweating those short-term margins right now, this is absolutely fantastic news for the companies providing the actual physical computing power and infrastructure.
And this perfectly explains why we are seeing these massive, wild gains in companies you'd probably never associate with a tech boom. This infrastructure push is directly lifting heavy construction and energy providers. Quanta Services, which builds electric plants, saw its stock surge nearly 16% to a record high. Independent nuclear power providers like Constellation Energy are perfectly positioned too. Because think about it, AI data centers require massive, constant electricity surges. So the companies that literally keep the AI lights on, they are becoming the new market darlings.
All right, Section 3, the Hormuz energy shock.
Yes, tech is booming, but we really need to pivot to the very real geopolitical shadow casting a huge chill over the global economy. And that starts with $4.30. Ouch. That is the average price of a gallon of gas in the US right now. It's the highest we've seen since July 2022, right after the onset of the war in Ukraine. For the everyday consumer, this is exactly where all that macroeconomic data turns into real, daily financial pain. The culprit here is pretty clear. The stalemate in the Iran conflict and the subsequent American blockade in the Strait of Hormuz has severely choked off global oil supplies. We are talking about roughly 20% of the world's oil supply being completely cut off from freely traveling that route. This sent Brent crude to an intraday peak of $126 a barrel.
Compound that with some refining crunches happening right now in the U.S. Midwest, and you have an energy shock that brings this whole geopolitical crisis straight to the consumer's pump.
Which leads us into Section 4, Inflation and the Fed.
This energy shock leads us directly into our next critical piece of the puzzle, and that's inflation. First, consider the recent economic rebound. We saw a Q1 GDP growth of 2%, which is a really solid bounce back from that sluggish 0.5% we saw in the fourth quarter of last year. But here is the kicker. That growth was driven almost entirely by business investments into the AI build-out we were just talking about. Consumer spending is holding up okay, but it's really the corporate AI spend that's keeping the economic engine humming.
Now, to understand the true threat to this growth, we have to look at the Fed's absolute preferred metric, core PCE. This is the index that strips out those super volatile food and energy costs so we can measure underlying consumer inflation trends. And right now, folks, the numbers are flashing some serious warning signs.
Those high energy costs pushed overall inflation up to 3.5%, which is its highest level since August 2023. Core PCE is sitting at 3.2%. However, incoming Fed Chair Kevin Warsh, he's actually taking a slightly different view. He prefers trimmed mean metrics, which put underlying inflation a lot lower, closer to 2.3%. Warsh is arguing that the massive productivity gains generated by AI might actually be a deflationary force, potentially giving him the runway to still cut interest rates despite the energy shock. So we have this fascinating standoff between heavy, energy-driven inflation and the promise of AI-driven deflation.
Okay, let's jump to Section 5, Corporate Shifts and Shakeups.
Let's zoom in on how this macro environment, the high-tech spending, high oil prices, the inflation debates, is causing massive ripples across individual corporate storylines. A huge shift is underway over at Berkshire Hathaway. As Warren Buffett steps away, the new CEO, Greg Abel, is taking the helm with an unprecedented $370 billion cash pile. That is 31% of the company's assets just sitting in cash. While some people see that as a drag on returns, it represents an immense amount of dry powder. If these geopolitical jitters or private credit fears create a market dislocation, Abel is perfectly positioned to deploy that capital and buy up assets at bargain prices, much like Buffett did during the 2008 financial crisis.
Elsewhere, we are seeing intense volatility across a surprisingly wide, almost scattershot range of sectors. In retail, Lululemon stock dropped 13% after they named a new CEO amidst a really fierce proxy fight. Meanwhile, in Washington, legal bounds are being tested. The DHS is expanding surveillance with a massive 300 million person database, while simultaneously, the Trump administration launched a new federal matching initiative for retirement savers. It is just a wildly varied landscape of boardroom and public sector turbulence right now.
And hey, for those of you looking for a contrarian, almost insider play amidst all this AI frenzy, analysts at Fundstrat, led by Tom Lee, have a really interesting take. While hardware and chip stocks are soaring to the moon, the software sector has actually struggled, dropping 18% this year, out of fear that AI is just going to destroy their business models. But Lee suggests the beaten-down software sector, specifically tracked by the IGV ETF, is actually primed for a massive asymmetric rebound over the next 2 years. His argument? The best software companies aren't going to be destroyed by AI, they're going to adapt to it and leverage it to become even more profitable.
Finally, that brings us to our conclusion. We have seen some truly incredible cross-currents today, from the historic heights of chip stocks and the billions being poured into AI data centers, all the way to the sobering reality of $4.30 at the gas pump driven by the Hormuz blockade, which really leaves us with the ultimate multi-trillion-dollar question as we wrap up this explainer from May 2026, can AI outrun geopolitical gravity? Will the unprecedented productivity promises of artificial intelligence be enough to keep the markets soaring, or will the sheer weight of energy inflation and global conflict finally pull this market back down to earth? Thanks so much for learning with us today, and definitely keep your eyes on the data.